You know when you look at a company's annual report and it feels like you're trying to read a completely different language? Well, today we're going to decode that language. We're breaking down financial statements, which are, let's be honest, the ultimate tool for getting the real story behind a business. Let's dive in.
I mean, when you look at some of these massive companies, do you ever just stop and wonder, how are they actually doing? Are they rolling in cash, or are they secretly drowning in debt? It can feel like this big secret, but the answers? They're usually hiding in plain sight, right there in the financial reports.
Here's the best way to think about it. Financial statements are basically a full medical checkup for a company. They show you all the vital signs, the overall condition, and even the performance history. This is how we as analysts diagnose its financial health. So here's our game plan. We're going to start with what I call the financial snapshot. Then we'll move on to the performance video. After that, we'll get into the owner's story. And finally, the best part. We'll see how it all clicks together when you read the full report. Let's get started with that snapshot. First up is the statement of financial position. So, if the whole set of reports is a health check, think of this statement as that one high-resolution photo the doctor takes. It captures the company's entire financial condition in one single moment in time. What you're looking at is basically a big, organized list. It's designed to show you two core things: everything the company owns and everything it owes to other people. It's this perfect balance of resources and obligations, all captured on a specific day, like, say, December 31st. All right, so on one side of that list, you've got the assets. This is all the valuable stuff the company actually owns. We're talking about tangible things like its buildings and equipment, the inventory of products sitting in a warehouse, and of course, good old cash in the bank. And then, on the flip side, you have the liabilities. This is pretty straightforward. It's everything the company owes to someone else. This could be big bank loans, or it could be as simple as the bills from suppliers that they haven't paid yet. So what happens if you take all the stuff the company owns, the assets, and then you subtract everything it owes, the liabilities? Whatever is left over, that's the equity. It's the owner's piece of the pie, the shareholder's stake in the company. It's things like share capital and retained earnings. And this brings us to, honestly, the single most important rule in all of accounting. Assets must equal liabilities plus equity. This equation has to balance, always. No exceptions. It is the fundamental law of the financial universe. Okay, so if that last statement was a still photo, this next one is a video. The statement of profit or loss doesn't just show you one moment in time. It shows you how the company performed over a whole period of time, like an entire year. This statement tells a story. The story of money coming in and money going out. It starts right at the top with all the money the company earned, and then it subtracts all the different costs of doing business until it gets to that one famous number everyone talks about, the bottom line. It's actually a pretty simple journey down the page. You start with revenue. That's all the cash from sales. From that, you subtract the cost of sales, what it costs to actually make the stuff you sold. Then you take out all the other expenses, and what's left after you pay your taxes, that's your profit for the year. But wait, that's not quite the whole story. All right, here's where it gets a little more interesting. What if a company owns a building, and that building has doubled in value, but they haven't sold it yet? That gain is real, for sure, but it's not cash they earn from their day-to-day operations. These kinds of unrealized gains or losses get recorded in a special section called Other Comprehensive Income, or OCI. Now, OCI itself is split into two really important types. Some of these items might eventually hit the main profit statement in the future. They get recycled. But others, like the gain on our property's value, will not. And knowing this difference is absolutely crucial because it gives you clues about where the company's future profits might come from. Okay, so we've seen the snapshot of the company's health, and we've watched the video of its performance. This third report, the statement of changes in equity, well, this one tells the owner's story. It lays out exactly how their stake in the company grew or shrank over the year. Think of this statement as a bridge. It literally connects the dots. It starts with the owner's equity value at the beginning of the year, shows you everything that happened in between, and gives you the final number at the end of the year. It's the story of how shareholder value is created, or destroyed.
So what's actually changing the numbers here? Well, the biggest driver is usually the total comprehensive income. That's the profit for the year plus all that OCI we just talked about. But it also includes other big moves, like if the company issued new shares, or on the flip side, paid out dividends to its owners.
So, we've walked through the three key reports, but here is the absolute secret, the real magic behind all of this. They are not separate documents. They're 3 chapters of the exact same book, and they link together perfectly to tell one single coherent story. Let me show you how.
It all starts here. You take that famous bottom line from our performance video, the profit for the year that's on the statement of profit or loss. That number is our starting point.
Now, that profit figure doesn't just vanish. It flows directly over to the owner's story, the statement of changes in equity. It gets added to the pot, increasing the slice of the company that belongs to the shareholders.
And here's where we complete the circle. That final total equity number from the end of the owner's story, it becomes the exact same equity number that we saw on our very first snapshot, the statement of financial position. It all links up, and that is what makes that fundamental accounting equation balance perfectly. See? It all connects.
And there you have it. Once you understand how these 3 statements work on their own, and more importantly, how they all connect with each other, that is a genuine superpower. It gives you the ability to do a real health check on almost any business out there and see what's really going on under the hood.
So now you know how to read the story of a company's past. But just remember, these statements are historical. They tell you what happened. The real art, the real challenge, is using this information to predict what happens next. And that, well, that's the whole world of financial analysis and a story for another time. Thanks for watching.